IT, let's now move to finances and let's try and understand what the big move from the RBI, that bazooka of a 50 bips cut, really implies for our finances. That's you and me, and what is it that investors should be doing, and how is it that you actually read into such a large move by the central bank and how it would translate into the real economy? Who better than who does declining interest rates really translate into the real economy? And more importantly, I want you to talk about, personal investment angle. How does it change finances for all of us?
Yeah, thank you, Aisha. Thanks for having me on the show, and very happy to have interaction on this issue, which is very close to my heart. Actually, the surprise cut of 50 basis point, as well as the putting in 2.5 lakh crores of rupees into the market through CRR C cut is actually a, a step which will force the execution of the gap between the execution and the announcement of policy will bring down to very low, and that's we have already seen. Immediately after that, the lower interest rate has happened on housing loans, on car loans, on the existing loans also. The interest rates on the fixed deposits as well as on the same bank deposit has come down. So this is what actually was the intent. Otherwise, if you take baby steps, the transmission of that was already taking a very long time. With one booster dose, I think one it is brought a lot of liquidity into the market. That is number one, and number two, the execution has become much faster than ever before.
All right. Hi, Mr. Singh. Morning. This is Shrishti also joining in. But also talk to us about what implications can it have on one's debt portfolio? Because with interest rates declining recently, what advice are you giving to your debt holders? Because of late, we are seeing that there is indeed a rise in the popularity for the short duration funds.
Yeah, of course. Till now, I mean, the mutual fund debt funds were not in focus for the last at least 3 years, ever since the tax regime was changed, and the income on the debt funds was made as a marginally taxable as per the slab of the person. But with the interest rates coming down, one on the longer side, people have made a lot of money when there has been good capital gains and the securities. And on the shorter side, when vis-a-vis bank deposits, there's a definitely a premium over the bank deposits at the shorter term. For example, the majority of the saving bank depositors are now earning somewhere between 2.5 to 3.5%. Whereas in the liquid fund also it's 5.5%. There's a possibility to put money in short-term funds where it is 6% plus kind of YTMs. Of course, it will keep on changing. There's no fixed return, but the differential between these rates and the mutual fund debt funds rate is almost 150 to 200 basis points as of date. So naturally, these will come into the limelight. And second, and more important thing is that over the period of time, the trust over the mutual fund debt scheme has gone high. There's no more that trust deficit, which was there for the timing when there was some problem with one or two debt funds. But of late, the way debt funds are being managed by the mutual fund industry, now there's a lot of attraction which is likely to come from not only from the corporate clients but from HNIs and ultra HNIs also.
Mr. Singh, point taken. This is Snehi also joining in. Another instrument that we're seeing that's gaining a lot of traction these days is arbitrage funds because they're tax efficient and they're also low risk equity. But how do they compare against the short term debt instruments like bonds that we're seeing in the market right now?
See, eventually the arbitrage funds gives you the opportunity to have the carry rate plus some of the arbitrage opportunities which actually keep on coming into the market from because of the dividends, because of so many other things in the market. So generally, we have seen that arbitrage funds have given around 100 basis point more than the policy rates, and this is when they have become meaningfully big in number. So when this kind of opportunity is available with the tax efficiency of that of the equity funds, and naturally so because this is all equity instruments only. So if equity is involved in this, because there are risks also involved, a little bit of risk is also involved. But generally, these are becoming very, very attractive. And because of, as you rightly said, the tax efficiency of short-term tax of 20% and long-term tax of 12.5%. So naturally, there's more attraction coming. But there's one caveat that it cannot be, say, unlimited number. There has to be some capacity constraint. There will come some capacity constraint if a lot of money starts coming in. And when from here on, it can go up by 40 to 50% more. Thereafter, if we get more money, then the returns will start coming down in these funds. But as of now, yes, you are right. Arbitrage fund is one which is actually attracting a lot of funds as of late.
So, Mr. Singh, where exactly, or rather, what's the nature of the funds that investors are right now looking at? Are they more drawn towards equity, or it's largely debt?
No, honestly speaking, what is happening today? There are three or four things which have been accepted by individual investors. Number one, they have to have some portion of their money being put in the has to be put in the equities. Second is they don't want a very high volatility, and with the kind of valuations which are there in the equity market, today the hybrid funds are actually, we are calling it hybrid funds. Actually, these are the needed solutions for individuals. I'll take one by one if we go by that. The conservative hybrid fund for all those people who are into the lower tax trajectory now with the 12 lakh rupees there, which is there. So if somebody is putting money in conservative hybrid fund, and then with the 25% of the money, around 20-25% money going into the equities, these are likely to give a kicker to the returns over the period of 3 to 5 years. Nobody can take a call on the 1 year. Since the redemption is also very not very much there in these funds, so fund manager can take a call on the higher accrual on the debt instrument also. That is the first category. Anybody who is into the lower interest category, that is one of the best category in the industry. Second comes the multi-asset allocation fund, which is generally people are putting more than 35% into equity category, thereby making them eligible for 12.5% tax with two-year holding period. And these funds are putting not money not only in equities and debt instruments, but in the precious metals also. That is the category which can be done either by the lower tax paying category audience or the higher tax paying audience. It suits everyone. So today, returns plus tax efficiencies are the name of the game. People have to look at both. So these are something. So after multi-asset fund, we have the category of multi-asset. Sorry, this equity savings fund. Equity saving fund is again a category where around 35% is put in, including arbitrage as well as the long equities, 20%, 15%, 15%, 20%, whatever ratio could be, depending upon this thing. These funds are also actually this fund and multi-asset allocation fund to some extent can be bracketed. So these are the funds people are finding it very, very attractive. So multi-asset allocation fund, equity savings fund, conservative hybrid fund, and balance advantage fund, which is fourth one in the category, which again is as per the fund manager's call, they keep on moving anywhere between 0 to 100%. Of course, nobody has ever been a zero, but there have been instances, for example, when market was very high, we were as low as 25-27% into equities, remaining in fixed income instrument. Today, with the valuation, when the correction happened, we are now around 55-56% into equities. So that is how fund managers keep on moving. So mutual funds are knitting solutions for the people. It's more of the solution push rather than the product push. That is the era, and especially after the RBI's this booster dose which has come, I think there will be more attraction towards the mutual fund, and we have seen the data over the period of time, we used to be only 12-13% of the bank deposits. Mutual fund industry used to be 12%. Today, we are 32% of the bank deposits. And even the FDRs, people were putting almost 60% of their surplus into fixed deposits, which has come down to as low as 45%. And the money has moved to other financial assets. Of course, a major part has come into mutual fund schemes. That's very, very healthy for mutual fund industry.
Right. So, Mr. Singh, if someone were to come to you right now to build a portfolio, I know everyone's investments are tailor-made to their requirements. But prima facie, let's take an example of someone in their 30s and the other person in their 50s, and they're like, we need a portfolio done for the next 5 years. What kind of a breakup would you advise them in terms of what kind of mutual fund schemes should they actually be picking up right now, looking at how the world and the markets are right now?
Yeah, of course, as you rightly said, every individual is a different institution. I mean, age is not a 50-year person with having a lot of money in his accounts, and it's not a survival money. So naturally, 100% will go into the equity-oriented funds. But if somebody is in the 50s and 60s who has to survive on the cash flow coming out of these funds, we cannot push 100% equities. So that's how, and what is the cash flow, individual's cash flow, in addition to the core income, because today in India people have the core income, people have the other income also, which is the satellite income is there. So that's how we have to look at individually. But just for a 30 years person who has not been into the markets as of now, I don't think there's anybody today of 30 years bracket having surplus money and not being in the market. That's one thing. First thing, I would like them to come through mutual fund route only, because the fund managers are really, really doing a very hard work to find out a right kind of company. Come through equity fund, 30 years will definitely put more allocation into the equity funds, but some money for liquidity purpose has to be in the arbitrage funds and the short-term funds, so that we have the whole 360-degree solution for any individual. Bank accounts are to be used for the transaction purpose, are being used for the transaction purposes. And I think the time will come when, as the global markets are, the bank deposits will be lesser than the capital market products, including debt funds. And the bank accounts will be used for the transaction purposes only. This journey is already on, as I already said. We are already 32% of the bank deposits in the country from 10% in 5 years. I think in next 5 years will be more than 50% of the bank deposits. The industry will be more than 50% because of the trust generated by mutual funds and the kind of liquidity which is being given, T+2, T+3, T+1. So this kind of liquidity, and with the click of button, the money can come to your account. So those are the things which will make the things happen. But conservative, multi-asset, balanced advantage fund are the three categories. These are for, but only thing is the how much is the horizon. My only please don't come into any fund which is having equities with the and the horizon is less than 3 years. Please don't be there. Less than 3 year fund, be in arbitrage fund, be in say money market funds, be in short term funds, but not in equities, because equities can always surprise you positively as well as negatively. So that's something which is my suggestion to the investors.
Guys, Mr. Singh, we let you go. Thank you as always for joining in with your insights.
Thank you, Aisha. Thank you. Thanks a lot. Thank you very much.
Okay, let's move on and let's tell